Welcome to the deep dive. Our mission today is pretty laser focused. We're not just looking at how to manage money, but really how to escape the gravitational pull of consumer culture to achieve true financial independence. We're taking a deep dive into the philosophy of J.L. Collins, it's deceptively simple but incredibly powerful, and the sources we've pulled for this are just fantastic. A lot of it started as a blog he wrote for his daughter, basically a lifelong instruction manual. And the whole premise is that getting your money right, it does more than make you rich. It improves every single option you have in life.
It absolutely does. And I think, if you're listening, the first thing to grasp is this fundamental lie our culture tells us about money. We're taught to think of it only in terms of consumption.
Right. What can I buy?
What can I buy? A new car, a bigger house, or maybe I'll pay off this debt just so I can go get more debt. The real power of money, and this is the core of the simple path, is that it can work for you. And in doing so, it buys your freedom. It's the ultimate tool for optionality.
And before we get into the nuts and bolts, we have to hit you with the most controversial piece of advice right up front, especially if your goal is early financial independence. The common wisdom. It's just wrong. You probably don't want to buy a house. That house is far more likely to make you financially poorer than renting. Okay, so let's unpack this whole thing. If you had to boil it down to, a single law of physics for financial independence, what's the core philosophy here?
It really breaks down into 3 core steps. And you can't skip them. You can't go to step 3 first. 1, you have to aggressively avoid and then destroy all high-interest consumer debt. 2, you have to live on substantially less than you earn. And 3, you invest the surplus. You let time and compounding do all the heavy lifting.
The principles themselves they sound pretty straightforward, so why is it so hard for most people to actually stick to them?
It goes back to that first point. Debt. Debt is a ball and chain. It's like asking a swimmer to compete in a race with a weight strapped to their waist. You just can't win. You can't be financially independent if you are constantly paying interest to somebody else. You're just running in place. But once that weight is gone, that's when the crucial shift happens. All that surplus money, the money you used to spend or used to pay in interest, now gets diverted into investments. Collins calls this buying your freedom.
I love that phrase.
It's perfect, right? Because as long as you have to exchange your time and your labor for money, you are beholden to whoever pays you. And that's a hard limit on your freedom. Financial independence makes work optional. That's a huge power shift in your life.
Okay, but the biggest pushback, and the sources mention this, is people immediately think, well, this only works if you have a massive income. I need a 6-figure salary. If I don't have that, why even bother with this aggressive savings mindset?
And that is absolutely the lie our culture tells us. The sources have this perfect counterexample of a friend making $1 million a year.
$1 million a year.
And he was completely, utterly broke.
How is that even possible?
He fell victim to what Collins calls the tyranny of the must-haves. He got sucked into competing with the Joneses. It's this social pressure that just constantly ratchets up your expenses until they meet or exceed your income. What's interesting is that people with lower or even middle incomes are often forced to be more disciplined from the start. And that actually makes it easier to adopt the core discipline. Your savings rate, the percentage you save, is so much more important than the size of your income.
So it's not the size of the shovel, it's how much dirt you're consistently putting in the wheelbarrow every single week.
Precisely.
Okay, let's drive straight into the fire here. This advice about avoiding home ownership, this flies in the face of everything. For most people, the house is their single biggest asset. It's the best hedge against inflation, right? My mortgage payment is fixed for 30 years, but rent just keeps going up. How do you argue against that stability?
You're right that a fixed mortgage hedges against inflation. But you're only looking at one side of the ledger. You are totally ignoring the massive and, more importantly, the unpredictable expenses that homeownership forces on you. First off, the entire industry, the banks, the agents, they're all incentivized to push you to buy the most house you can possibly afford.
Right, they stretch you to the absolute limit.
Exactly. It turns the asset into a burden. When you rent, your housing cost is clean. It's predictable for the term of the lease. When you own, the mortgage is just the starting point.
So what are those hidden costs that make it such an anchor?
Oh, they are endless. Property taxes are always going up. Insurance, utilities, they inflate. And then you've got all the variable costs. Maintenance, landscaping, fixing appliances, and this is a big one, all the new furniture you need to fill the extra space you just bought. But the real wealth killer is the major repair. The thing that blindsides you. People forget about the $20,000 roof.
Or the HVAC system that dies in the middle of summer.
Yes. or the $25,000 septic system replacement. These are huge, non-optional cash injections that just destroy your ability to invest and build wealth. So Collins reframes it. He calls house ownership an expensive indulgence, not an investment, unless you can very easily afford those hits.
And the numbers really back this up for younger generations. I mean, since 1980, U.S. home prices are up over 300%. That has totally outpaced wage growth. Median wages since the year 2000 are up, what, maybe 15%? The barrier to entry is just sky high.
And that leads to the critical non-financial cost, which is the massive loss of flexibility.
Flexibility.
When you buy a house, that debt psychologically anchors you to one spot. It makes it so much harder to decide to move if a better career opportunity comes up.
Say moving from Plymouth to London or just to another state.
Right. And selling a house is just enormously expensive.
The friction cost.
Massive friction costs. Real estate commissions, taxes, moving fees.
Yeah.
You lose a huge chunk just getting in and out. Getting out of an apartment, you might lose a security deposit. Getting out of a house is a huge, cumbersome process. You've essentially traded your optionality for that house.
It's interesting because all this discipline, it has to start somewhere. And for a lot of people, that starting place is dealing with a mountain of debt. Let's go back to the tactical advice for someone who's deep in the hole, like that friend in the sources with $40,000 in debt.
The sources are very clear here, and it's purely mathematical. You focus aggressively on the debt with the absolute highest interest rate first.
Yeah.
You pay the minimums on everything else, but every single spare penny you have goes to that highest rate.
Okay, I have to challenge that a little because a lot of experts push the snowball method, pay off the smallest debt first, just to get that psychological win, for motivation. Which approach does this philosophy favor and why?
It favors the math, the avalanche method. While, we recognize the psychological win of the snowball, this is all about optimizing your return. That high interest rate, say 25% on a credit card, is the single biggest guaranteed return you will ever get on your money.
By not paying it.
By not paying it.
Right.
You're getting a 25% return. If you want to buy your freedom as fast as possible, you have to be as mathematically efficient as possible. And here's the good news. While you're destroying that debt, you are building the crucial muscle. You're learning to live on less than you earn. So that disciplined lifestyle, once the debt is gone, it just immediately transfers to building assets. The practice is the key.
Let's pivot to FU money. It's a fantastic term, but I think it gets confused with full financial independence. How should we distinguish between those two?
Yeah, that's a great point. Financial independence is the finish line. That's when your assets can fully support your life forever and you never need to work again. FU money is the financial strength you build on the way to that finish line.
So it's a milestone.
It's a powerful milestone. Long before you can retire, just having, say, 6 months or a year's worth of expenses saved up gives you enormous leverage. It means if you have a toxic boss or a horrible job, you have the strength to say F you and walk away. You know you can survive comfortably for months while you find something better. It's strength now, not just decades from now.
The sources have this really painful example of the psychological trap of spending. This person who would repeatedly buy a 60-inch TV and a PlayStation on payday, just for that dopamine hit, for validation, and then a week later, they'd have to sell it all when the credit card bill came.
Yeah, and that behavior is all driven by seeking external validation. And the reality is expensive stuff just doesn't provide it. It's like that classic Ferrari analogy.
Yeah.
If you buy a Ferrari to impress people, they're not thinking, wow, what a cool, successful person.
No, they're thinking,
wow, I would look so cool driving that Ferrari. They are always thinking about themselves, not you. The underlying truth here is that money just magnifies who you already are. If you're an unhappy person, money will probably just make you a rich, unhappy person. Money is extremely good at removing unhappiness, the stress of debt collectors, the anxiety of bills, but it doesn't create joy on its own.
okay, let's switch gears to the engine that actually powers this whole thing, investing. A lot of people, especially when the market is volatile, they think stocks are unsafe or just too complicated. What's the right way to think about the long-term safety of stocks?
They are the single strongest wealth-building tool in history. But you have to look at them through the lens of time. They are very, very volatile in the short term, days, months, even a year or two.
Right.
But they are stunningly reliable over the long term, 10, 20, 30 years. So the core rule is simple. Never invest money in stocks that you need in the next 5 to 10 years.
And this is where that beer and foam analogy is so perfect for explaining the difference between the noise and the actual value.
It really is. So imagine a big glass of beer with a huge head of foam on top. The stock's price at any moment is the beer and the foam. The beer is the real fundamental value of the companies, their sales, their profits, their assets. The foam is all the speculation, the hype, the fear, the greed, the daily news cycle.
So all the volatility we see day to day, that's the foam.
Yeah, it is the foam. And the foam is always reacting, it's always churning. But over the long term, the foam always dissipates. And the price will eventually track the underlying value of the company. It will track the beer.
So if the plan is to own the beer and ignore the foam, what's the best tool for the average person to do that?
It's broad-based, low-cost stock index funds. Specifically, something like Vanguard's VTSAX, which tracks the entire U.S. market. When you buy that one fund, you are buying a tiny piece of almost every publicly traded U.S. company. We're talking about 3,600 businesses.
From the Apples and Amazons all the way down.
All the way down. And this creates what Collins calls a self-cleansing mechanism. It's brilliant. As old giants like Sears begin to fade away, they are automatically replaced in the index by the new winners like Walmart or Amazon. You, the investor, don't have to pick the winner. You just own the whole economy, and you capture the growth of every successful company that comes along.
And all of this gets magnified by compounding, the eighth wonder of the world. That example in the sources is just stunning. You invest $500 a month at an 8% return for 35 years, and you end up with over $1 million. But $850,000 of that comes just from growth, not your contributions.
That is the ultimate secret. And it leads directly to the core advice from Jack Bogle, who created index funds. He said to invest and then don't even open your statements for 20 years.
Because the biggest risk is you.
It's you. He called investors the tinkerers.
Vanguard data actually showed men underperform women in long-term returns.
Why is that? Because men trade 45% more often. They're always trying to time the market, which leads to higher fees and more mistakes. The best investor is the one who forgets their password and just lets time do its magic.
Let's move beyond the tactics to the bigger life decisions. If money doesn't guarantee happiness, what is its actual, its profound purpose?
Its purpose is to give you options and to remove predictable unhappiness, the stress of scarcity, of bailiff letters, of not being able to afford a medical bill. The lack of money guarantees challenges. The presence of money gives you the power to choose your challenges and to choose how you spend your time.
There was that fascinating research about how the brain sees our future self as a stranger. Like, our 6-year-old self is like a celebrity, someone disconnected from us now, which makes young people care less about their future finances.
That finding is exactly why the idea of building immediate financial strength is so important. That FU money we talked about. You're not saving for some theoretical 75-year-old stranger. You're saving for your 30-year-old self.
That's a great way to put it.
The author noted that the first $5,000 he saved at age 25 was immediately useful. It gave him the confidence to negotiate leaving his job to go travel Europe. It was strength he could use right then. The benefit of savings comes way before retirement.
Okay, speaking of immediate life-altering risks, what is the single biggest non-financial risk that can just wipe out everything you've built?
Divorce. It is financially devastating. It can set you back decades. The sources detail these proceedings that drag on for 5 or 6 years, where assets you thought had a certain value are subjectively inflated by the opposing lawyer to get a bigger split. And this can force you to liquidate investments you've held for 20 years, taking massive tax hits, just to split the cash.
So marrying the right person is, without a doubt, one of the biggest financial decisions you will ever make.
It absolutely is. You have to be intentional about your financial partnership.
Yeah.
And if you don't create your own prenuptial agreement, the government provides one for you. And that prenup is decided by a judge who doesn't know you, doesn't know your sacrifices, and doesn't know your goals.
Wow. Okay, so finally, for the listener who feels a little overwhelmed by all this, the VTSAX, the compounding, do they need a financial advisor to navigate this?
Generally.
No.
It's called the simple path for a reason. It's designed to be executed by you. And by the time you know enough to choose a good advisor, which is really hard, you probably know enough to just handle this yourself. Plus, you have to be aware of the inherent conflict of interest.
Right.
An advisor paid on assets under management, well, they might advise you against paying off your mortgage.
Because it reduces their income?
Exactly. It reduces the capital they manage, which directly reduces their pay. Your priorities and their income might not align.
This has been a complete deconstruction of a philosophy that is. It's simple, but it is so powerful. The central takeaway seems to be that this simple path is about acquiring freedom. It's about intentionally spending your dimes on buying assets, your freedom, not just consumables. Money doesn't guarantee happiness, but the lack of it absolutely guarantees challenges.
And if you connect that to the really big picture, the final reflection is about perspective. Nothing ultimately matters on a cosmic scale, but life can be a really good, fun ride, and you should make the best of it. And financial freedom gives you the most choices in how to make it a good ride.
So here's a final thought for you to consider, and it comes from the parable of the minister and the monk. The minister was powerful and wealthy, but he was deeply beholden to the king. The monk lived very simply on just rice and beans. The minister said, if you could only learn to cater to the king, you wouldn't have to live on rice and beans. And the monk replied, if you could only learn to live on rice and beans, you wouldn't have to cater to the king. So the question is, which side are you closer to? The one who needs substantial wealth to avoid serving, or the one who needs so little that they never have to serve at all? Consider which choice is truly buying you the most freedom. We'll see you on the next deep dive.